Welcome back. Noted economist Jim Grant, known for criticizing the Fed. He says the central bank's easy money policy is creating opportunities in one area, private equity. Jim Grant of Grant's Interest Rate Observer joins us now for an exclusive interview. As always, first, Jim, I want to talk to you about the opportunities. How are you? Good to see you,
fine,
by the way. But let me get your take.
By the way, I'm not an economist, Maria.
You're right. But you have the goods.
Yeah, right. Okay.
To be called an economist.
I've got a couple of ideas.
Okay.
Tell me so the world is wide open with respect to credit, right? No credit, no problem. Junk bond yields, lows, leverage loans accessible, and on and on. Also, the stock market, as you have observed, Maria, is levitating. This is a perfect world for people that deal in private equity. And there are two publicly traded private equity and so-called alternative managers that actually offer a margin of safety apart from these opportunities that have part and parcel with very easy money.
You know, you rarely talk about public stocks in terms of being beneficiaries or getting an impact from the policies out there. Which are those private equity firms?
Blackstone, BX, and KKR. You can guess the ticker,
right.
KKR.
KKR.
Right. Both of them are doing very well in these areas. Both of them are adding assets under management. I think Blackstone had like 98 or 90-something billion in 2009, and now it's got over 200. Both are seeing opportunities to sell companies in which they have invested. Both, of course, are beneficiaries of extremely low interest rates and accessible credit. And both pay kind of good dividends. Both yield around 6% this year, will yield around 6% this year or higher. And both trade at multiples of what they call economic net income, which is kind of a massaged price-earnings ratio in the high single digits.
I love this idea. I really do. Private equity is certainly doing well in this environment. I'm, I guess, a little surprised that we haven't seen more deals, given the fact that rates are at such low levels. Shouldn't we be seeing a whole host of deal flow and deal activity?
We should and we may. Of course, the opposite side of the coin of a buoyant stock market is higher valuations and less attractive targets in the public arena. And as a stockholder in Blackstone, I was glad to see Blackstone back off from a bid on Dell. But, you know, these companies are kind of out of the mainstream. If you were a stockholder, you're actually a unit holder. You get a K-1 form as if you were a limited partner in almost a hedge fund. The accounting is eccentric because GAAP doesn't quite do these companies justice. So you have to look at the so-called economic net income. And then, too, there's this seeming paradox of private equity companies being in the public markets. I mean, if private equity is so great, why are they public? So there's a lot of bad will, I think, toward these companies. But they offer that thing that is most scarce today in the public markets, namely a margin of safety. They are actually cheap, especially when compared to their public counterparts. You know, these companies get their money locked up for 10 years. You don't just take it away from them. Whereas the mutual fund companies, their money can and sometimes does walk out the door on a given bad day. They trade these companies, for example, T. Rowe Price and Franklin Resources, either in the high teens of earnings or, in the case of T. Rowe, closer to 20 times. So it seems to me an oddity and an exploitable oddity that the public alternative asset managers, Blackstone and KKR, are as cheap as they are.
Yep, I like the idea a lot.
Okay.
Let me ask you a bit about what else is going on, because the last time you were here was right before this new debate came out about the Fed slowing down the policy by the beginning of this summer, in 2013. Now, I recognize it's time to unemployment and it's time to the economy, but would you expect the Fed to start slowing down the stimulus this year?
No, because Fed has said that unless unemployment is better than 6.5%, people have been speculating on the Fed's pulling back since they started pulling forward. It seems to me the burden of proof must be on those who contend that the Fed is going to do less rather than more. It seems to me the Fed and the other central banks of the world are just getting into it. And by the way, does it not appear by the world's markets that we have achieved something like the kingdom of heaven? Sovereign bond yields scraping all-time lows in spite of unprecedented central bank activity. Stock markets, why would they stop? It's perfect, yet improving.
The perfect world. What about gold? I mean, you must have been just watching that screen, watching gold plummet a week ago.
Yes.
And thinking, what is going on here?
Well, the last thing I said to you the prior time you were gracious enough to have me on was gold stocks are really an interesting idea, and they're even more
totally
interesting
lagged.
now.
Yeah, totally lagged.
But I'm still bullish. I think that gold is the alternative, is the way to get short central banks. It's the way to get long the alternative to central banking. And gold stocks are cheaper than gold, so I'm very, very bullish indeed.
So was this just momentum? Was it margin calls? What do you think? Because I don't think... Well, I've not seen a decline like that.
No. It seems to me that it was largely the structure of the gold market, meaning the way it was owned and by whom it was owned and on what leverage, rather than anything having to do with the fundamentals of the gold market, which fundamental to me is the institution of managed currency, the central banking. It's aggressive, unprecedented money printing. That, to me, is a single fundamental of the gold market. So as long as that remains in place, it seems to me, you are compelled to look at an alternative if you're serious about the money you have earned. And that, to me, the principal alternative to central banks in the monetary realm is the ancient monetary asset they can't create.
And gold trades in a totally different region than other commodities. I mean, you look at like what's going on in copper, and you look at what's going on in iron ore.
The grains. Right. So gold to me is not a commodity; it is money. It's
money. Exactly.
Right. So, but also notice that there is no PE multiple, no yield. So it is a price, and therefore it is subject, in the short term certainly, to the vicissitudes of anything that is unanchored to a stream of earnings.
All right, we will leave it there. Jim, always wonderful to have you on the program.
Thank you, Maria.
Jim Grant is founder and publisher of Grant's Interest Rate Observer.